Welcome to our countdown of the top tax strategies for beginners. Tax planning. It's not just about meeting deadlines and avoiding penalties. It's about leveraging the system to your benefit, maximizing tax breaks, and minimizing tax liabilities. So, without further ado, let's dive into the countdown. Starting off at number 5, we have understanding your tax bracket. Now, what exactly is a tax bracket? It's the rate at which your income is taxed. The U.S. operates under a progressive tax system, which means the more you earn, the higher your tax rate. This system is divided into 7 brackets, each with a different income range and tax rate. For example, if you're a single filer in a certain tax year, your first chunk of income up to a certain amount is taxed at the lowest rate. The next chunk of income is taxed at the next rate, and so on, up the ladder of tax brackets. It's important to note that your entire income is not taxed at the rate of your highest bracket, just the income within that bracket's range. This system is designed to distribute tax burden fairly among different income groups. The higher your income, the higher your tax bracket, and the more tax you pay. The key takeaway here is that understanding your tax bracket is not just about knowing how much tax you'll pay, it's also about planning your finances effectively to potentially move to a lower bracket or to maximize deductions and credits. Remember, knowing your tax bracket can be the first step towards effective tax planning. Coming in at number 4, we have maximizing tax deductions. Now, what exactly are tax deductions? In simple terms, these are specific expenses that you can subtract from your taxable income during a tax year. By reducing your taxable income, tax deductions effectively lower the amount of tax you owe to Uncle Sam. Let's consider some popular tax deductions. One of the biggest deductions that taxpayers can claim is the mortgage interest deduction. This allows homeowners to deduct the interest they pay on their home loan. But that's not all. There are numerous other deductions available depending on your situation. You could be eligible for deductions related to education, healthcare, or even energy efficiency improvements to your home. The key is to be aware of these deductions and to keep track of related expenses throughout the year, so keep an eye out for those deductions. They can significantly reduce your tax bill. At number 3, we have utilizing tax credits. Now, tax credits are a little bit like a magic wand that can make your tax bill disappear. How so, you ask? Well, tax credits provide a dollar-for-dollar reduction in your tax bill. That's right, for every dollar of a tax credit, you save a dollar in taxes. Think of it like a store credit. If you have a $100 store credit, you can buy $100 worth of goods without paying a penny. Similarly, a $100 tax credit means you pay $100 less in taxes. Now, the tax code is filled with various credits, each designed to incentivize certain behaviors. For instance, there's the American Opportunity Credit, which can provide up to $2,500 per year for eligible college expenses. Tax credits are not one-size-fits-all. There are credits for energy efficiency, for adopting children, even for making your home more accessible. The key is to find the ones that apply to your situation. Remember, tax credits are a powerful tool to lower your tax bill. So don't let this magic wand go unused. Moving on to number 2, we have choosing between standard deduction and itemizing. This strategy can significantly impact your tax bill, so listen up. The standard deduction is a set amount that the IRS allows you to deduct from your taxable income. This is an easy choice if you don't have many deductions, or if your itemized deductions don't add up to more than the standard deduction. For instance, if you're a single filer and your total deductions are less than $12,400, the standard deduction is your best bet. On the other hand, itemizing deductions allows you to list out each deduction you're eligible for. These may include deductions for mortgage interest, state and local taxes, and charitable donations, among others. If these add up to more than your standard deduction, then itemizing is the way to go. But remember, itemizing requires meticulous record-keeping and a bit more effort come tax time. It's also worth noting that these options aren't mutually exclusive year to year. Some years, it might make more sense for you to take the standard deduction, while in others, itemizing could offer greater savings. The key here is to evaluate your financial situation each year and make an informed choice. In conclusion, whether to take the standard deduction or to itemize is a significant decision that can greatly affect your tax bill. So, weigh your options carefully when it comes to choosing between standard deduction and itemizing. And finally, at number 1, we have keeping good records. Now, this might not sound like the most exciting strategy, but it is undoubtedly the most crucial. Keeping good records is the bedrock of effective tax planning. It's like the secret ingredient in your grandmother's famous apple pie. You might not notice it when it's there, but believe me, you'll miss it when it's gone. Why is record keeping so important, you ask? Well, not only does it help you keep track of your income, expenses, and potential deductions, but it also comes in handy in the unfortunate event of an audit. It's your ultimate defense, your knight in shining armor, if you will. So, what records should you keep? Think of it as your financial diary. You'll want to keep track of your income, including wages, dividends, and interest. Don't forget about your expenses, too. These could be anything from your mortgage interest to your business expenses, and even your charitable contributions. It's also a good idea to keep a record of any tax returns you filed in the past. Now, onto the nitty-gritty. How should you organize these records? The best way to do it is chronologically. It's like baking a cake. You want to layer everything in the right order. Start with your income information, add your expense records, and finally, top it off with your tax return copies. This way, if you need to find something, you'll know exactly where to look. But remember, good organization isn't just about putting everything in the right place. It's also about keeping it there. Make sure to maintain your records for at least 3 years. This is the period of limitation where the IRS can audit your return, assess additional tax, or allow you to claim a refund. Keeping good records might seem like a chore, but think of it as an investment. It's an investment in your peace of mind, in your financial future, and ultimately in yourself. Remember, good record keeping is the cornerstone of effective tax planning. It's been a pleasure sharing these tax strategies with you. Until next time, keep those records straight and those tax bills low.